Money is often viewed as a purely logical matter, numbers to be managed, budgets to be balanced, investments to be calculated. But in reality, money is deeply emotional. The way we think and feel about money affects every financial decision we make. Fear and greed, two of the most powerful emotions, have a tremendous impact on our wealth, often sabotaging our best intentions. Fear is the emotion that can stop us from taking action. It causes us to avoid investments, hold on to cash, or sell when the market is down, often locking in losses. On the other hand, greed pushes us toward risky decisions, chasing quick returns without fully understanding the risks involved. These opposing emotions create a cycle that can undermine our financial growth. Neurological research reveals that the brain's fear center activates in response to financial uncertainty. This biological response often overrides rational thinking, leading us to make choices that feel safe in the moment but harm our long-term wealth. Understanding this can help us pause and reconsider before reacting impulsively. Greed, meanwhile, tricks us into believing we can beat the market or find the next big opportunity. It's the reason many fall prey to scams or risky investments, hoping to make a fortune quickly. Greed blinds us to potential losses and encourages excessive risk-taking. The cycle of fear and greed creates volatility in the markets and instability in our personal finances. When fear dominates, people sell assets in panic. When greed takes over, they buy impulsively. Neither extreme is conducive to building sustainable wealth. Recognizing these emotional triggers is the first step toward better financial decisions. By identifying when fear or greed influences our behavior, we can implement strategies to mitigate their effects. This might include setting strict investment rules or consulting with a financial advisor. One effective strategy is to create a long-term financial plan that accommodates market fluctuations. Such a plan helps reduce emotional reactions by focusing on goals rather than short-term market movements. Diversification also plays a key role in managing emotional risk. By spreading investments across different assets, we reduce the impact of any one market downturn on our overall portfolio, which can ease anxiety. Education is crucial. The more we understand how markets work and the history of their ups and downs, the less likely we are to react out of fear or greed. Knowledge builds confidence and reduces emotional decision-making. Finally, mindfulness and emotional awareness can be powerful tools. Being aware of our feelings about money allows us to step back and make more rational choices, breaking the cycle of fear and greed. Our childhood experiences shape our emotional relationship with money. If we grew up in a household where money was scarce, fear may dominate our financial decisions. Conversely, growing up around abundance may lead to overconfidence or a disregard for risk. Society also fuels emotional extremes. Media headlines, social media success stories, and economic panic all contribute to a culture of fear and greed. This constant stimulation pressures us to act, often irrationally. Emotional investing often leads to poor timing. Investors driven by emotion tend to buy when markets are high, greed, and sell when markets fall, fear. This behavior results in buying high and selling low, the exact opposite of what creates wealth. A useful tool to combat emotional decisions is automation. Automating savings and investments removes emotion from the process. With systems in place, we stick to our financial plan regardless of market emotions. Creating financial rules can act as a personal firewall. For example, I won't sell during a market dip, or I'll invest 10% of my income no matter what. These rules reduce the space for emotional interference. Behavioral finance, a field that blends psychology and economics, offers deep insights into why people make irrational financial choices. It shows that understanding our biases is key to overcoming them. One common bias is loss aversion, where we fear losing money more than we enjoy gaining it. This causes people to hold on to losing investments too long or avoid new opportunities out of fear of failure. The opposite of fear isn't greed, it's discipline. Discipline means sticking to your financial plan even when emotions scream otherwise. It's what separates wealthy investors from impulsive traders. Discipline is not about denying emotions, but acknowledging them without letting them take over. You might feel fear, but you don't let it stop you from investing. You might feel greedy, but you check yourself before chasing unrealistic returns. Accountability can also help. Sharing your financial goals with a trusted friend or advisor provides external support and helps keep emotions in check. Talking about money reduces the shame and anxiety often tied to it. One powerful way to gain emotional control is journaling. Writing down your thoughts and feelings about money, especially during big decisions, helps you recognize patterns and separate emotion from logic. Let's be clear, emotions are not the enemy. They provide valuable information. The key is learning to listen to them without obeying them blindly. Awareness creates space between feeling and action. Greed often disguises itself as ambition or optimism. It tells us, just one more trade, or this time is different. When you find yourself chasing unrealistic returns, pause. Ask, am I being greedy or strategic? Fear, similarly, pretends to be caution. It tells you to stay out of the market, to keep your money safe, to wait. But excessive caution can be just as damaging as recklessness. It prevents growth. Financial success isn't about eliminating emotion, it's about managing it. You don't have to become cold or robotic. You simply need to create systems that reduce the power of momentary feelings. Understanding your money story can be transformative. This refers to the beliefs and experiences you've inherited about money, often subconsciously. Once you identify your story, you can choose to rewrite it. Some people's stories include beliefs like money is evil or rich people are greedy. These beliefs create internal conflict and emotional resistance to wealth. Recognizing them is the first step to breaking free. A healthy money mindset involves balance. You're not afraid to spend, but you do so intentionally. You invest for the future, but enjoy life today. You're cautious, but not paralyzed. You're ambitious, but not obsessed. One overlooked area where emotions play a major role is lifestyle inflation. As income rises, people tend to upgrade their lifestyle not out of need, but out of emotion, status, comparison, self-worth. Fighting lifestyle inflation requires clarity. What truly brings you happiness? Is it the luxury car or the freedom to work less? Emotional spending often masks deeper desires. Recognizing them can change everything. Many people confuse wealth with income. They feel rich because they earn a high salary, but if spending equals or exceeds income, they're not building wealth, they're just living expensively. Greed can show up in the form of over-leveraging, taking on too much debt to chase bigger gains. This is especially dangerous in market downturns, where leveraged losses multiply quickly. Fear also disguises itself as oversaving. While saving is good, some people hoard money out of anxiety. They avoid investing, miss opportunities, and let inflation silently eat away at their purchasing power. Financial literacy is emotional armor. The more you understand how money works, compound interest, investing, budgeting, the more confident and less reactive you become. Knowledge calms fear. One of the most dangerous emotions in money management is envy. Seeing others succeed financially, especially online, can drive us to take risks we're not ready for, just to keep up. Social media distorts reality. Most people share highlights, not the full story. That millionaire crypto trader you admire may be drowning in debt behind the scenes. Don't compare your behind the scenes to their highlight reel. Long-term wealth building is boring but effective. There's no drama in steady investing, living below your means, and staying consistent. But this boring path is what leads to true financial freedom. A common trap is trying to get rich quick. Emotional impatience fuels this mindset, but sustainable wealth is rarely fast. The faster the gain, the higher the risk, and the greater the emotional volatility. Financial growth mirrors emotional growth. As you become more emotionally mature, more patient, thoughtful, and disciplined, your money habits improve too. Wealth becomes a reflection of your inner stability. The journey to financial mastery is emotional work. It means confronting fears, examining beliefs, resisting temptations, and building discipline. True wealth isn't just a number, it's who you become in the process. Mindfulness is a powerful tool for emotional control. When you pause, observe, and name what you're feeling, fear, excitement, greed, you reclaim control over impulsive financial decisions. Emotions are temporary, but financial consequences can be permanent. That's why cooling off before making big financial moves like investments or purchases is so important. Creating written financial goals helps anchor you during emotional storms. When fear or greed strikes, your goals remind you of your bigger purpose and keep you on track. Automating your finances like saving and investing reduces the room for emotional interference. The more decisions you remove from your day-to-day thinking, the fewer chances for emotions to sabotage you. Surrounding yourself with the right people also matters. A supportive financial environment, friends, mentors, or communities can keep you grounded and help you make wiser choices. Don't underestimate the emotional impact of financial trauma. Past experiences like bankruptcy or growing up in poverty can create money anxiety. Therapy or coaching may help heal these wounds. Learn to track your emotional spending. Ask yourself after a purchase, did I really need this? What was I feeling when I bought it? Over time, this builds emotional awareness around money. Celebrate progress, not perfection. Financial growth isn't a straight line. There will be mistakes, setbacks, and emotional slip-ups. What matters is learning, adjusting, and moving forward. Freedom from emotional sabotage doesn't mean you'll never feel fear or greed again. It means you'll recognize them, understand them, and choose wiser responses, not reactions. That's real financial power. In the end, your relationship with money is a reflection of your relationship with yourself. Heal the emotions, and the money will follow. Emotional mastery is the gateway to financial mastery. If you found this video helpful, don't forget to like, leave a comment, and subscribe to Money Mode for more insights on mastering your mind and your money. Let's grow smarter together.